You've spent decades building real wealth. Now you're facing the financial decisions nobody prepared you for. And most of them come down to one thing: taxes. This is The Bracket, the show for people with at least $2 million who are approaching or already living in retirement. Because at this level, the real threat to your money isn't the market, it's the tax code. I'm Ryan Knoll, founder of Nav Wealth Partners. Every episode, I give you the same tax frameworks we use with our own clients. Real numbers, plain language, no products, no pitch. Just the strategy you need to keep more of what you built. If you've worked hard enough to have a tax problem worth solving, you're in the right place. This is The Bracket. Let's get to work. Here's a scenario that plays out in my office more than you'd think. A couple comes in, early 60s. They did everything right. Maxed the 401k for 30 years, lived below their means, and they've got, let's say, $2.5 million sitting in tax-deferred accounts and another $2 to $3 million in brokerage accounts. They're feeling good, and then I show them a number they've never thought about. The tax bill they're going to hand the IRS in their mid-70s, whether they want the money or not. Because here's the thing nobody told them. That $2.5 million isn't really theirs. A chunk of it, sometimes a really big chunk, belongs to the government. They just haven't paid yet. And the longer they wait, the more the bill tends to grow. Today, I want to walk you through the single most powerful tool we have to take control of that bill before it controls you. It's called the Roth Conversion Corridor. By the end of this episode, you'll understand how to estimate what your tax rate will actually be in retirement, how to find the window of years where the conversions are cheap, and how to do the math yourself on the back of an envelope. And this is important because a lot of the strategies we will talk about use the Roth Conversion Corridor as a starting point. It's one of the main pillars of our retirement planning approach here at Nav Wealth Partners. If it makes sense for you, the next question is how much you should convert. If it doesn't make sense, other strategies we will talk about in future episodes can take its place. So let's get into it. To understand the corridor, you first have to understand what we're racing against. And what we're racing against is the required minimum distribution, the RMD. Here's the deal with a traditional IRA or 401k. You got a tax deduction when the money went in. It's grown tax deferred for decades, but the IRS was always going to collect. So at a certain age, they force you to start pulling money out and pay tax on it, whether you need the income or not. Now the age this kicks in has changed recently, and under current law, if you were born before 1960, your RMDs start at 73. If you were born in 1960 or later, they'll start at age 75. So why is this a problem? Well, there's two reasons. First, the amount you're forced to withdraw is based on a formula, the IRS Uniform Lifetime Table. At 73, the divisor is about 26.5. So you take your year-end balance, divide by 26.5, and that's your forced withdrawal. On a $2 million IRA, that's roughly $75,000 of income you didn't even ask for. And every year, that divisor shrinks and the distribution gets larger. By your early 80s, you're being forced to pull out 5, 6, 7% of the account annually. Now, the second reason, and this is the part that stings, that forced income lands on top of your Social Security, on top of your pension, on top of your dividends and interest. It stacks. And it can rocket you into a tax bracket far higher than the one you've lived in during your actual working years. So picture the timeline. You retire at, say, age 73. You've got this gap. Call it the years between retirement and when RMDs hit. During that gap, your income might be low. You may be living off cash or taxable accounts. And then bang, at 73 or 75, the RMD switch flips and your taxable income jumps off a cliff. That gap, those low income years before the cliff, is where the entire game gets played. That's your corridor. Before you can do anything smart, you have to answer one question. What tax bracket am I going to be in once RMDs are in full swing? Most people assume their rate drops in retirement. For the high net worth saver with a 7-figure IRA, that assumption is frequently dead wrong. Let me show you how to actually estimate it instead of guessing. You're going to project your income at, let's say, age 75 if that's when your RMDs start, and add up the pieces. Piece 1 is the RMD yourself. Take your current IRA balance and grow it forward at a reasonable rate to your RMD age. A $2 million IRA at 63 will go to $3.6 million by the time RMD starts if you earn 6% a year over that time frame. Then you're going to want to divide by that first year divisor, roughly 26.5. That's about $135,000 of forced income on your $3.6 million IRA. Piece 2 is Social Security. A high-earning couple is often looking at combined somewhere between $50,000 and $70,000 a year, and up to 85% of that is taxable. So call it conservatively $50,000 of taxable Social Security. And then piece 3, everything else. Your pension if you've got one, interest, dividends, capital gains from your taxable brokerage account. For a couple starting retirement with a $3 million brokerage account, that can easily be another $80,000 to $100,000 of dividends, interest, and capital gains by the time RMDs roll around. Add it up. $135,000 plus $50,000 plus $100,000. And you're staring at roughly $285,000 of income when RMDs begin. And that's only going to grow every year after, then as your balances grow and required distribution percentage increases. Now let's price that. In 2026, for a married couple filing jointly, the brackets run like this. The 10% bracket goes up to $24,800. The 12% bracket runs up to $100,800. The 22% bracket runs up to $211,400. And the 24% bracket runs all the way up to $403,550. And that is taxable income. So our couple at $285,000 of gross income has roughly $250,000 of taxable income and is sitting comfortably in the 24% bracket, and they have no choice but to take it. Here's the kicker. If that same couple in their corridor years is only showing $80,000 to $100,000 of gross income from their brokerage portfolio, they have a ton of options. That gross income equates to $50,000 to $70,000 of taxable income and leaves them squarely in the 12% bracket. So you've got a person who will be a 24% or higher taxpayer for the rest of their life, sitting currently in the 12% bracket right now for a few years doing nothing about it. That gap between the bracket you're in today and the bracket you'll be forced into later, that is the arbitrage. That's the whole opportunity. And the conversion corridor is how you harvest it and save hundreds of thousands of dollars. So now we get to the actual strategy, the corridor. The idea is simple to say and harder to execute. In your low-income years, you deliberately convert money from your traditional IRA into a Roth IRA, and you pay tax on it now, voluntarily, at today's lower rate, to avoid paying at a higher forced rate later. When you convert, the converted amount counts as ordinary income this year. You pay the tax, but that money is now in a Roth, where it grows tax-free, comes out tax-free, and critically has no RMDs at all. You've permanently diffused that portion of the future tax bomb. Now here's where amateurs go wrong. They either don't convert at all, or they panic convert a giant lump sum and accidentally launch themselves into the 32% bracket, paying more than they ever would have on the RMD. Both are mistakes. The professional move is bracket targeting, sometimes called bracket filling. You pick a ceiling, a target tax bracket, and you convert exactly enough to fill up to the top of that bracket, and not $1 more. Let me make it concrete. Say our couple is retired, age 63, and their gross income this year before any conversion is $80,000. We've decided, based on that future 24% plus projection, that filling the 22% bracket is a screaming deal. The top of the 22% bracket for a married couple in 2026 is $211,400. So we work backwards. They've got the standard deduction, $32,200 for a married couple in 2026, which means their gross income can be higher than their taxable income. But let's keep it clean and work in taxable income terms. They're at $80,000 of income, but after the standard deduction, their taxable income is closer to $48,000. The top of the 22% bracket is $211,400. So the room available, their corridor, is roughly $163,000. That means we can convert about $163,000 from the traditional IRA to the Roth this year. And every dollar of that conversion gets taxed at either 12% or 22%. Do that for a decade of gap years, and you're talking about 6 figures of permanent tax savings, plus a far smaller RMD bomb because the account is now smaller. That's bracket targeting. You're not converting a lot or a little. You're filling a specific bracket up to a specific line on purpose every single year until the corridor closes when required distributions begin. Now, I keep throwing around the phrase taxable income, and if you're going to do this right, you need to know exactly what it means, because the conversion strategy lives and dies on getting this number right. Taxable income is not your gross income. It's built in steps. You start with all your income from every source, wages if you still have them, IRA withdrawals, the conversion amount, Social Security, pension, interest, dividends, capital gains. Add it all up. That's your total income. From that, you subtract your deductions. For most retirees, that standard deduction, which in 2026 is $32,200 for a married couple filing jointly. There are some additional standard deduction amounts available once you're 65 or older, which push that figure higher. Whatever you subtract, what's left in your taxable income, and that's the number the brackets actually apply. Why does this matter so much for conversions? Because the deduction creates free room. Your first roughly $32,000 of income is wiped out before the brackets even start. So when you're calculating how much corridor you have to layer it correctly. Deductions come off the top. Then your other income fills the bottom brackets, and your conversion fills whatever space is left up to your target ceiling. Get this wrong by even a few $1,000s, and you spill over into the next bracket, which on a conversion means you voluntarily overpaid. Precision is the entire point. This is not a set it and forget it maneuver. It's a number you recalculate every single year because your other income changes every single year. Which brings me to the most overlooked piece of the whole strategy. Here's the mistake that costs people real money. They think the corridor is just about the conversion. It is not. Every other dollar of income you have uses up corridor space first. Think of your tax brackets as a stack of buckets. The bottom bucket fills first, then the next, then the next. And your conversion doesn't get to cut the line. It goes in last on top of everything else. So it fills the buckets before your conversion. Interest from bonds and savings, that's ordinary income, fills the bucket. Required distributions if you're already taking them. Pension income, wages from any part-time work. And here's the one people forget. Capital gains and qualified dividends. Now, capital gains and qualified dividends have their own preferential rates, 0%, 15%, or 20%. And there's a beautiful feature in 2026 where a married couple can have up to $98,900 of taxable income and pay 0% on their long-term gains. That's its own strategy, and it's called gain harvesting, and it's wonderful and something we're going to talk about in future episodes. But here's the conflict. And this is the part you have to internalize. Capital gains still stack on top of your ordinary income when determining how much room is left. Even though gains are taxed at their own rate, they still occupy space in the stack. So if you fill your corridor with a big Roth conversion, you push your ordinary income up, and you can shove your capital gains right out of that 0% zone and into the 15% zone. Or you do the reverse. You harvest a bunch of gains at 0%, and now there's no corridor left for a conversion. You cannot maximize both in the same year. Every year you're making a choice. Is this a conversion year or a gain harvesting year? And $1 of dividends or interest you didn't plan for is $1 of conversion room you just lost. This is why we model the entire income picture before we convert a single dollar, because the conversion is the last thing that goes in the bucket, and everything else gets there first. And one more landmine I'll just flag. Once your income climbs past certain thresholds, you can trigger higher Medicare premiums through IRMA, and you can drag more of your Social Security into taxation. Those are corridor costs too. The point stands. All of your income interacts. You manage it as one system, not as separate pieces. And IRMA has its own income basis for comparison, Modified adjusted gross income, which is all of your income added together, plus some tax-free interest items that get added back without factoring in your standard deduction. It's a discussion for another episode, but one we need to think about when tax bracket targeting. So let's tie it all together. The forced income cliff is real. RMDs start at 73 or 75, depending on your birth year, and for anyone with a serious tax-deferred balance, they can lock you into a higher bracket for life. The corridor is your window, those lower income years before the cliff, where you can voluntarily convert at today's tax rates instead of tomorrow's forced rates. The strategy is bracket targeting. You estimate the bracket you'll be forced into later. You compare it to the bracket you're in now, and you fill the gap on purpose up to a precise ceiling year after year. And the discipline is in the details. You build your taxable income correctly, you account for the deduction, and you remember that every other dollar, interest, dividends, capital gains, fills the stack before your conversion does. Done right, this is one of the highest return things you will ever do with your money, not because you earn more, but because you've kept more. And the difference between a couple who runs this play for a decade and one who ignores it can be hundreds of thousands of dollars. If you take one thing from today, the best time to fix your future tax bill is in the quiet years before the IRS forces your hand. That window is open now. It does not stay open forever. I'm Ryan, and this is The Bracket. That's it for this episode of The Bracket. If something here made you rethink a decision you were about to make, that's the whole point. Go deeper before you act. And if you want help applying any of this to your own situation, the team at Nav Wealth Partners does exactly this work. Tax strategy for the distribution years, for households like the one this show is built for. There's a link in the show notes to schedule a conversation with one of our advisors. Click to see if you're a fit. And if this episode was useful, do me one favor. Follow the show and leave a rating wherever you're listening. It's the single biggest thing that helps another retiree with the same questions actually find us. Quick but important note. Everything on this show is educational and for general information only. It is not personalized investment, tax, or legal advice, and listening does not create an advisory relationship with Nav Wealth Partners. Nav is a registered investment advisor. Your situation is your own. Please consult a qualified professional before acting on anything you heard here. I'm Ryan Knoll. Thanks for listening to The Bracket.